Good day. Welcome back to the class. We are almost at the end of our sessions of the subject of investment analysis and portfolio management. And we've covered a great deal of distance from the first lecture, and very recently we were talking about the different aspects of the derivatives markets, in which we were talking about different forms of utilizing derivatives. One of the forms that we discussed was hedging. And we talked about short hedging or long hedging. So long hedging, we discussed, would be something in which you would be expecting the market to be going up, and then you can buy first and sell later. On the other hand, if we were talking about short futures hedge, we would be talking about a market that might go down. So maybe you could be looking at selling an asset and then covering it back in the futures market. One of the best ways we discussed of utilizing the derivatives market was through the process of hedging. And we eliminated, or we did not talk very highly about speculation, because speculation is dangerous, but is very much a very strong component of the futures market. While we talked about the difference between a cash spot market or a regular market and the futures market, we used one word called basis, which is another word for spreads, which is another word for the difference between the bid and ask price, or another word for the difference between the prices in the spot market and the prices in the futures market. So basis would be the difference that we can take advantage of. But there is also a word called basis risk, which arises because of uncertainty about the basis, and the hedge is closed out because of the risk factors. While we are hedging, we've obviously talked about using the same product in both the markets. So you choose a delivery month, you choose a product, you choose a quantity, you choose a quality, and you find out what the life of the hedge is. But one day, you will come across time that you might not find the ideal product in the futures market. So maybe we will then use the most appropriate alternative to the product. While doing this, we would then be getting involved in a word called cross-hedging, meaning not choosing the same product to be hedged, but getting around to a fairly reasonably likable product in the futures market. So cross-hedging would be something that you could use as a means of talking about hedging, or talking about using it as a reference to the cross-hedging and using another product to support your underlying asset. So you could do this by selecting another product. We also use hedging to save ourselves from any untoward incident in portfolios. So, in doing that, we are able to safeguard our diversified investments inside a portfolio. Since it's not possible to utilize exact particular shares or particular products in both the markets, so we can use hedging by hedging maybe in the futures market, in the stock index future. So hedging may be cheaper than selling out a portfolio and buying it back, because remember, there are commissions involved in buying and selling products. So you could use hedging of a portfolio in larger context and then avoid all the expenses involved in buying and selling. So hedging price of an individual stock would be maybe similar like hedging a portfolio, but the synergies are different for a single stock versus synergies of a portfolio. It does not work well because only the systematic risk is hedged. In a portfolio, we're talking about a quantity which is greater than a single stock, and then a variety of different shares. So we're really not talking, or really not very concerned about just systematic risk. We're also concerned about unsystematic risk. So unsystematic risk that is unique to the stock is not hedged. So when we are hedging, the unique case is that unsystematic risk unique to the stock is not covered. while we're also looking at aspects of systematic hedging covering the entire portfolio. So this is important for us to understand that hedging of an entire portfolio is good because it saves us from unnecessary buying and selling commissions if we think that we might not be looking at a very good market. So you could keep the portfolio intact in the regular market and trade in the futures market and try to cover up the potential of loss or hedge the loss or minimize the risk factor involved in futures and regular market trading. And we take advantage of the basis risk. Now, the equity returns are also avoided. The returns can be maximized by avoiding unnecessary costs. I just mentioned about that. And we can understand if we have included good stocks, we've included good investment stocks in the portfolio, and we really don't want to lose them or sell them in an environment that is uncertain, we would then use hedging of the portfolio in the futures market. So hedge is a good backup, hedge is a good idea to avoid unnecessary costs, and then it ensures that we'll have the basic portfolio with us, and also we'll also be covering up the uncertainties involved in futures market, involved in equity trading, and we'll be able to maximize our profits based on these hedging potentials of the portfolio. Now we can use a series of futures and hedging from one month to another month, called rolling on of the hedging in the futures market. So maybe we've not achieved our target in 1 month or in one defined period, then we can roll over the same position into another period of the futures market or another month or another contract. So obviously, remember, whenever we are switching from one period to another period, we're rolling one hedge to another period, we are becoming exposed to some sort of a basis risk as well. There is going to be a definite price difference between one contract period and another contract period. One. Secondly, there's always the risk that you might not be able to catch the tide in the right place. So you use these as a matter of fact. Hedging would then be a better way than speculating, and of course arbitrage is not all that bad altogether again. Some of the uses that we discussed were the ways how we're going to use the derivatives, but why do we need to use the derivatives for hedging, speculating, or for arbitrage? One of the reasons is risk management, another is risk transfer, and still another is financial leverage. So you are able to manage risk by using two different forms of the market, and then you transfer risk from one person to another person, from a hedger to a speculator, or from one market to another market, and you use the financial leverage aspect as part of the process, which you are able to use more funds to your advantage. So you use risk transfers as one reason, you use risk management as another reason for the uses of the derivatives. When we were on the subject of risk management, we understood that one of the primary motives of a hedger is to manage risk. We understood that someone who's talking about the market going up would be a bullish hedger, and somebody looking at the market going down would maybe be called a bearish hedger. So this is something that the hedgers look into while talking about the market and find better trends to follow than just erratic decisions or spontaneous decisions in the futures market. So you can use the financial leverage aspect by tailoring your risk exposure to any point depending on the bullish or bearish continuum. You can switch over positions from being bullish to bearish and vice versa, looking at the trend of the market. So you manage risk by looking at the trend and then following the trend the way it should have been followed. Now, the reason that we showed you one of the slides previously in the previous lectures, and I would appreciate if you look at the slide once again because it refreshes your mind, is that you have a pull in both directions, whether the market is rising or the market is falling. So you expect the market to rise or fall in any direction. So in a bullish sentiment or a bearish sentiment or in a neutral scenario, you're able to understand the expectations of the market, which way the market will go. Since we're talking about two markets and we're talking about the futures market and we're talking about hedging to be used in the market, or the reasons why you use the futures market, one of the reasons I just mentioned was risk management. You are able to transfer risk from the regular market to the futures market by way of being a bullish hedger or a bearish hedger. But risk must be quantified and risk must be decided as to the limits that have to be set for the risk management. Exceeding risk, taking unnecessary risk will not be helpful to your style of doing business. And these exceeding of risk limits are actually not acceptable when we're talking about booking profits. So we need to keep diversified, we need to be with the trend, and we need to look at the environment and the scenario and do the analysis that is important. Because for all users of the derivatives market, we must understand the more the market is understood, the better for us, because it is still an unexplored frontier. It is something that has to be seen in depth, and if we are unable to understand derivatives, I think it can backfire on us in a bad way. Because of the financial leverage that's used, it can give you tremendous amounts of areas to cover and use your reasonable funds in more exaggerated ways. You could use the derivatives for income generation. So you are able to generate income from your regular market. You can also use the futures market to generate income as well, because you can play both markets at the same time. So what you're doing is increasing your ability to utilize the same time and get better results from two different markets, the regular and the futures market. One of the ways that you could increase income generation is by writing a covered call. Now, what would writing a covered call mean, and how would it generate income? Everybody who's buying, everybody who's going long will have somebody on the other end as well to be writing the call option for them. So it involves somebody taking you up on your decision to go long or short, and will come up with the exact contract for you. Somebody who's buying from you, if you bought a long option, then somebody would write that option for you. That would be called a covered option, for which a premium shall have to be paid. So somebody who's writing a covered call option will be given a premium, which is for him to keep whatever the circumstance or whatever the end result is. So writing calls, especially popular during flat periods, during neutral periods, with not much excitement in the bullish or bearish trend, and writing covered calls is particularly very significant as part of sources of income generation in flat periods where the market is not trending anywhere. So you use the options premium as ways of generating income, because that is yours to keep no matter what happens. So there is certain sort of guarantee for the writer of a call or a put option, where the premium would be for the person who's writing to keep whatever the results of the options is. The premium amount is one way of utilizing the derivatives market and increasing your income. I mentioned a word called financial engineering. Now, financial engineering can be understood by way of a practice of using derivatives, the advantage of somebody who's building blocks and in the creation of some specialized product. So you can use financial engineering as part of the process for somebody who's making a product in the financial world and will use it as building blocks to improve on the eventual product that has to be launched. So financial engineering is ways of working with the new financial product, maybe securitization, maybe writing calls. So financial engineering, or using that as a leverage to make new products, diversify your base into other products. Derivatives can be stable, derivatives can be volatile, depending on how they are combined with other assets. So you could use two assets in the futures market and in the regulars market, which will be done through financial engineering and create products for the better utility of investors to use two markets to their advantage. The more product, the more financial engineering one is able to do, the more people are attracted to the diversified nature of investments available in the financial world. So financial engineering, income generation then would be another way of using the derivatives market. So you use derivatives generally as means of building blocks for improving and diversifying the natures of your products, which would mean then that financial engineers would then be able to select from a wide array of puts, calls, futures, and other derivatives, and combine them to make another financial product known. We do understand that derivatives actually are neutral products. Derivatives actually have no value on their own, and neither they are risky nor safe, but they're based on some underlying asset, and that is where you derive the value from. So if we are talking about calls, if we're talking about puts or futures or forwards, we're actually looking at the underlying asset through which any value can be derived. So you combine less potent products with more potent products, or products which have values with products which actually are inherently neutral. Because as such, derivatives would have nothing to offer if you cannot understand the value of a base, the value in a regular market. So to effectively study derivatives, it is important for us to understand that all financial institutions can make some productive use of the derivative assets. All financial institutions must be in a position, all financial institutions must have the capacity to use different financial markets to be used for their benefit and for use to be utilized by investors. It's not just the regular market, it's not just the equity market, it's not just the fixed market, it's also the derivatives market that has to be used as an array of different investment alternatives for people to invest in. So you could be talking about investment houses, you could be talking about asset liability managers at bank, you may be talking about pension fund managers, mortgage fund managers, different people in the market, different people who are using the financial world as a means of earning an income and then use it for different financial engineering and then use the derivative market for advantage for the products to be used by investors. So then, what are options? We referred to call options, and we talked about options being products and parts of the derivatives market. Options would have call option. Call option gives its owner the right to buy. Mark my words, it is not a promise to buy. It gives the owner the right to buy, which is different than a promise to buy. It's an option. Just like any plain English word, option is an option, is not a promise. It's a right. For example, a store holding an item for you for a fee is called an option. You've gone to a shop, you just liked something, and you just put down some earnest money that you'll be back and collect the product and put in the rest of the money. So that's enough. You may not go back. In that case, you relinquish the amount that you'd given to the shopkeeper, and then he's not bound as well. It's an option that you can use or exercise. And on the other hand, then you would have put options. Call option and put option. The put option then would be an option that gives its owner the right to sell, not a promise to sell. So these are to be understood. Put options and call options are rights, not promises. So you may let it go unexercised, or you may use it. Two words that you need to remember are the put option and the call option, and then you need to understand the characteristics of options as well. The option premium is another word that you must put inside your minds, is the premium amount with the option. Option premium is the amount you pay for the option. You do not pay the entire amount. You put up with a word called premium. So you use premiums to get involved in the options market. So there are going to be times that you're going to be talking about exchange traded options. And remember, exchange traded orders fungible is a new word again coming up for you. Fungibility product is important. So exchange traded options are fungible. For a given company, all options of the same type with the same expiration and striking price are identical. Same things coming up for fungibility. Striking price then would be another word then. Striking price of an option is its predetermined transaction price. You decide first, you predetermine first what the strike price is going to be for which you're going to settle for the trade. Don't forget the words premium, fungible, and strike price. These are characteristics of an option. Fungibility, I will explain to you once again, would mean the same expiry date, the same quality, the same quantity, the same contract period, the same product, and so which would mean that options are fungible. We must also be talking about expiry dates. Expiry dates would mean when the term of the option will expire. So, expiration dates. Let's assume Saturday following the third Friday of certain designated months for most options. A date is determined on which the option shall expire. Let's assume the last Friday of a month would then again be an expiry date. A striking price would be, once again, the predetermined transaction price in multiples of 2.5, 5, 7.5, $10, 2.5, 5, 7.5, 10. Those would be the variety of ways, the transactions regime in which you talk about striking price, depending on current stock prices. Now, current stock prices can lead the striking price. So we would need to look at the underlying sentiment of the price, the underlying asset. Another word that you will remember, the security that the option gives you the right to buy or sell, the underlying asset. Both puts and calls are based on 100 shares of the underlying security, which means what? One contract then would be equal to 100 shares. Remember, 100 shares is equal to one contract, whether it's a call option or a put option. The 100 shares would be the underlying asset. The underlying asset would be converted from 100 shares for academic reasons into one contract. So if you're talking about 10 contracts, you're actually talking about 1,000 shares. Okay? So remember, you must understand where options are coming from. So unlike futures or unlike more familiar securities, there is no set number of put or call options. The number in existence changes every day. There is no limit, there is no barrier to how many options can be traded in a day. As long as there is demand and supply, as long as you have underlying assets, you'll have a variation in the quantity of options available for you to trade in. More words for you to remember. More words to be joined in for your dictionaries. Open interest is another word you need to remember. An open interest is the total number of contracts outstanding have not been settled. Settlement price is another word for you to remember, is the price just before the final bell each day. Volume of trading would be another term that you must remember, is the number of trades in one day. Open interest, settlement price, and volume of trading are new words coming up in the terminology of the options market. So openness would be equal to the number of long positions or the number of short positions which have to be completed, have not been decided. Settlement price would be the price at the end of each trading day. We'd used a word called mark to market, in which you were able to decide what you lost today and what you gained today. So you do it by finding the price at the end of the bell of each day and decide what did you do. And volume obviously would be the number of trades in one day. Trades. We're not talking about open interest, because open interest would mean long positions and short positions. The interest of the people, but have not been completed. So open interest actually lets you know how much interest there is in the market for any particular option, be it call, be it put. More words for you. You must remember words. Another word would be in the money. In the money options have a positive cash flow. If you use it immediately, if you exercise it immediately, an in the money option would have a positive cash flow. Another word would be out of the money. And out of the money would be that it should not be exercised immediately. Call option, the strike price would be less than the exercised price. In the money and out of the money are two different kinds of options. They're not kinds actually. They tell you about the monetary value of the option. There is an intrinsic value. Intrinsic value is the value realized from immediate exercise. I just talked about in the money option. So intrinsic value is the value realized from immediate exercise. Prior to options maturity, remember there is supposed to be a maturity period for everything. Prior to maturity period, option premium exceed intrinsic value, which means time value is equal to option price minus intrinsic value, equal to seller compensation for risk. We're talking about risk in the futures market. So there has to be a seller's compensation for the risk, and time value is equal to option price minus the intrinsic value in the money option. Intrinsic value is the value realized from immediate exercising of the option. Unless we are able to grasp, comprehend, understand, evaluate, visualize the terminology involved in options, we shall probably be confusing, blurring our minds, blurring our vision, confusing everything, and maybe going for a wrong decision, for a wrong product at a wrong time, which will then devastate all your plans of future cash inflows based on what you did understand from the terminology. The options terminology is tricky. The options terminology is new. The options terminology has not been understood before. But before you do anything nasty, I recommend you must understand the terminology, the words associated with the products. Words like strike price, words like expiry dates, words like premium, words like in the market, words like out of the market. You must understand all these. So would you remember what a call or a put is? A call would mean then a buyer has the right but not the obligation to purchase, which would mean sell a fixed quantity from or to the seller at a fixed price before a certain date. That is I think the crux of the matter. If you look at the things that I've just said, exercise price, fixed price, expiry date, certain date, you'd understand that it has to be some words, some domains, the parameters through which we are able to use the option. So option premium or price would be paid by the buyer to the seller to get the right. The seller then would be a writer. So option premiums are the prices that you pay for options, and the writer of the option will then keep the premium, whatever the result of that particular trade may be. So by paying the premium, you buy the right from the seller, from the writer of the option, whether it's a call option or a put option. The premium pays to the writer, premium adds to the price of the buyer of an option. You must understand calls and puts are the same things as going long or short, are the same things as going buying or selling, but are different markets. The question is, why do you need an options market? You have the regular market, the spot market, you have the futures market. Why do you need an options market? In the financial derivative securities, you understand by now that the financial derivative securities derive all or part of their value from an underlying asset. Options are created by investors, sold to other investors. This is financial engineering. Investors have created a new product so that you can use one product, diversify it into futures and options, and use other ways of utilizing the same underlying asset in a variety of ways. So investors have created options to buy and sell with other investors. Question again is, why trade these indirect claims? Maybe expanded investment opportunities, or lower cost, or increase leverage. I just mentioned investors have actually come up with all these brilliant ideas by being able to use one product in a variety of ways. If you're using these stocks just in the regular market, it may not be fun anymore now. Well, that was the only way we knew about trading in the stock market, was going into the cash market, going into the regular market, and doing the business like it should have been. But since things have improved, new variations have come up, new products have come up, new alternatives have come up. You look at one underlying asset to be utilized in a variety of ways, and that was done through the market of derivatives. And you use derivatives in a way nobody understood it before. And then you came up with futures and options. But are options a good idea? Is it really worth getting into the options market? One problem is it increases risk, but there is instantaneous information available. So then maybe options are a good idea after all. And there is portfolio risk management by transferring risk from one market to another market. You transfer risk from one market to another market, from one person to another person. And you get financial leverage by using your funds in a bigger way, through margins, through premiums, and not to forget about income generation as well. And you do that by writing covered calls. So there are a lot of good ways that you could use the options market. So you know how good they can be, but you must also understand how they work. So you could be talking about call buyer, call seller, in which you expect the prices of the underlying asset or the underlying product to increase if you're a call buyer, or decrease, or maybe stay steady if you're a call seller. If you're a buyer, if you think underlying asset is going to improve; seller, if you think underlying asset is going to stay same or diminish. A put buyer or a put seller would then expect the price of the underlying asset to decrease or increase or stay steady. The put buyer would looking at a price decrease. A put seller would maybe looking at a price stability or a price increase. And option maturity, we talk about how options work. At option maturity, we look at options that may expire worthless, be exercised, or be sold. You've got to exercise it before the option expires, or you could let it go waste. You could let it go unexercised So at option maturity, an option may expire worthless, be exercised, or be sold. A number of ways options work. You could work as a call buyer, as a put buyer, as a call seller, or a put seller, or let it go waste and not take advantage of it. So if you look at the ways options can work, you must understand also how options are traded. So if options are to be traded and options are to be used, you must understand options exchanges are continuous primary and secondary markets. Options are exchange traded. The Chicago Board of Options Exchange is the largest exchange, more commonly called the CBOE. It stands for the Chicago Board of Options Exchange, where standardized excise dates, standardized excise prices, and standardized excise quantities exist. Facilities are available, facilities offsetting positions through Options Clearing Corporation, the OCC. The Options Clearing Corporation provides facilities for offsetting positions. The Options Clearing Corporation is a guarantor and handles deliveries. Like you have clearing houses in equity markets, you have clearing houses in the options market which handle all the deliveries involved in the options trading. So option trading is done on exchanges. Chicago Board of Options Exchange being the largest such exchange. The transactions, the handling of deliveries and guarantees are all handled by the Option Clearing Corporation. The two organizations definitely involved are the Chicago Board of Options Exchanges and the Options Clearing Corporation. We're talking about options trading and where they're traded and who handles them. And in options trading, we will obviously be coming across opening transactions and closing transactions. Obviously, whenever you begin a contract, it has to begin with an opening, and obviously, if it has to be used or exercised, there has to be a closing transaction as well. So you could have to understand that opening transaction would then be the first trade someone makes in a particular option is an opening transaction for that person, which means you maybe began by buying a call option or maybe began by buying a put option, and you determined an expiry date and determined a quantity and determined a price, the strike price, and determined a premium, which would then all fall in the category called an opening transaction, the first trade the person makes for the option. When the same person closes the transaction or closes the position, the second transaction with the second trade offsetting the first trade, the latter trade will be called the closing transaction. So you would understand by now what opening and closing transactions would be. When someone buys an option as an opening transaction, the owner of an option will ultimately do what? One of the three things will happen. When you get involved in an option, when you buy an option, there will be three normal things that will logically happen to that option. Since he's bought it, he would then maybe sell it to someone else. So one of the things that could happen to the options once you've bought it is that he will sell it to someone else, which would then be the closing transaction. If he doesn't do that, and if he's gone for an opening transaction, he's bought it, he could let it expire. Remember, we're not talking about promises. We're not talking about obligations. We're talking about rights. So you could let it go waste. You let it go expire. So you let it expire or you exercise it. Either you could sell it to someone, you will let it go waste by let it going expired, unused, or you could exercise it. It's an option. For example, buying a ticket to an athletic event is an option. You could sell the ticket to someone else. You may not go to the event and maybe it goes waste. Or you could go to the event and use it. So you could use it or you could lose it. You could exercise it, you could let it go waste, or pass it on to someone else for free, or sell it to someone. It's an option that you have since you've paid the price. While on the topic of opening and closing transactions, we must understand we've talked about who's bought something. You just not talked about somebody who sold it to somebody. If you bought the option from someone, when someone sells an option to you as an opening transaction, this is called writing an option. You bought it from somebody. You bought an option from some person. That some person is a writer who's writing an option. You're a buyer of an option and somebody is writing an option. We're talking about any one option. And no matter what the owner of an option does, the writer of the option keeps the option premium. Remember, one word we talked about, premium, is the price that you pay for getting the right to buy an option. You pay a premium. Premium is not the entire amount. So the writer of the call option or put option gets to keep the premium no matter what happens. So he or she will receive the premium. So writer then would have some sort of a guaranteed income, and that is what we talked about when we talked about generating incomes from the options market by writing calls or puts, writing options. Word I just mentioned was the Chicago Board of Options Exchange. Word I mentioned was the Option Clearing Corporation. And I briefly told you that it's responsible for the deliveries of the option. It's responsible as a guarantor of the options. Then what is the role of the Options Clearing Corporation? It is important for us to understand it contributes substantially to the smooth operation of the options market. We're talking about an exchange-traded option. So the Option Clearing Corporation helps facilitate investors, brings some sensibility to the business of the options market, and also is able to use that corporation as a means of making people feel comfortable that this is supposed to be a guarantor and will sort of matters for the investors. So the OCC positions itself between every buyer and seller and acts as a guarantor for all options traded. Becomes a middleman, becomes a guarantor, offsets the positions, is responsible for the deliveries, brings some sensibility to the market, and brings some calmness to the investors that there's somebody who's looking after their interests. So it sets a minimum capital requirement. The OCC has a minimum requirement and provides for efficient transfer of funds among members as and when gains and losses occur. Works the same way as a clearing company in an equity market. There's nothing different except the comfort level for investors involved in trading options. It's a very big market. It's $1 trillion market. And do you know where they're traded? They're traded on exchanges. But that doesn't mean they're not traded over the counter. They're traded on exchanges and they're also traded over the counter. And there are standardized option characteristics. So many other listed options as well. We've just not touched anything as yet on different kinds of options. There's trade mechanism involved in going into the business of options. I just referred to you the Options Clearing House, which is the middle institution between a buyer and a seller. What about the exchanges? Some of the major exchanges in the United States, the reason I need to refer to United States is because we don't have an options exchange here right now, but there will be one in the future. We do have a commodities exchange, although, and a futures market as well. But biggest work is done in the United States. The major options exchanges are the Chicago Board of Options Exchange, CBOE, for people who are excited about options. Another is the American Stock Exchange, more commonly called as the AMEX. I just mentioned the Chicago Board of Options Exchange and the American Stock Exchange as well, where you use the platforms for options. And you have one in Philadelphia as well, which is fondly called Philly. So you have the Philadelphia Stock Exchange, you have the American Stock Exchange, and you have the Chicago Board of Options Exchange. Let's not forget the Pacific Stock Exchange as well. Of course, these are not the only exchanges available in the world. I'm just talking about the United States of America, but there are other exchanges available in the world as well. Tremendous amounts of foreign option exchanges available. More of that later, if there is time. Right now, I'd focus myself towards exchange-traded options and over-the-counter options. We had talked at a great deal about exchange-traded funds and over-the-counter traded funds, exchange-traded stocks and over-the-counter stocks. But in the options market, with an over-the-counter option, we must understand that this is another form of doing business in the options exchange. So, with an over-the-counter option, we understand the institutions occur in private options arrangements with the brokerage firms or other dealers without involving the exchange in it. And remember, we talked about this in mutual funds, in the regular market, and in portfolio markets as well, that these over-the-market tradings are a bit different than tradings being done on the exchange. In this, the striking price, the life of the price, and premiums are negotiated between the parties involved in the options contract or the options trading. The exchange doesn't decide anything. The parties involved decide everything. So over-the-counter options are subject to counterparty risk and are generally not fungible. Fungible was the word I just mentioned a few minutes ago. These options should be fungible. There should be a fungibility in it, some sort of sensibility in it to be able to be traded. Maybe the exact quantities, exact strike prices, exact expiry dates, so that they are tradable, marketable. But since these options are all over the counter, it's difficult for us to understand how, if there is some sort of a problem that is arising, who's going to sort out the problem, because then that is the time you'd be talking about the options clearing corporation. The people who are involved in between the trading of the options. Something about exotic options as well that I'd like to tell you about is that there is an option called as you like it option. This is not about Shakespeare, this is about finance. This is as you like it options. The owner can decide whether it's a put or a call by a certain date. You can swap. It's a dicey thing. I wouldn't go for such a option called an as you like it option where you could switch over positions whenever you want to. So the owner can decide whether it's a call option or a put option by a certain date. Another option is called a barrier option, created or cancelled if a pre-specified price level is touched. Yet another option is a forward start option. You paid for now with the option becoming effective at a future date. I just talked about forward start option, a barrier option, as you like it option, in which you can change the characteristic of the option. A barrier option would be if its price is touched, and a forward option where you pay now and settle it later. So these are the sorts of options other than traditional call and put options which bring some excitement to the options market. Remember, options have been created by investors. Since they have been created by investors, there are a huge number of ways that they can make up newer options. Some of them are over-the-counter traded, since these can then be tailored to your individual tastes. You may like them or not, but these are the other companies that you can look at, ways to make money. We can talk about leap options, long-term equity anticipation securities called leap options. Options similar to ordinary listed options, except they're longer in term, maybe even more than 3 years, 39 months to be exact. These have to be looked at through your own eyes and see if they suit you. You go for short-term options, long-term options, over-the-counter options, exchange-traded options, barrier options, as-you-like-it options, leap options, forward options, call options, put options. There are a number of options that you could look at, since they're just options. Thank you very much.